off the back of the recent Bank of England decision to hold the Bank of England base rate at 3.75, there have been a whole host of articles and stories and opinions on the internet voicing the downfall of the UK property market. Bank of England issues warning as interest rates to rise 6 times. UK housing market in slump as buyers absorb extraordinary shocks. Adding to the fact that if you believe in the 18-year property cycle, 2026 is the year the property market is due to crash, then you've got what looks like a recipe for disaster and certainly a reason to not be buying property. When I sat down to read the paper this morning, or the internet as it is now, I was momentarily sucked into this negativity myself and oh god, that property as a way to make money is over. But I reminded myself that these sorts of shocks happen all the time over the years, and it's the people that play the long game that win. So I thought we'd have a quick look at two things. First of all, what does the Bank of England holding of the base rate actually mean for you and the cash in your pocket, and what does the future look like in terms of where interest rates are going? And then secondly, addressing the question of the UK property market crashing. And thirdly, added an extra one in there, why I actually think there's reason to be positive around the market despite a lot of negative sentiment. Firstly, interest rates. The Bank of England voted 8-1 to keep rates the same, with one of the members voting for an increase up to 4%. CPI, or Consumer Price Index, is now at 3.3%, and the government has a target of 2%. Now, why is that important? The government uses interest rates to control the supply of money in the economy. A lower supply of money in the economy has a downward pressure on prices and therefore CPI, and will bring CPI down from that 3.3% to the 2% target. How does that work? Increasing interest rates basically increases most people's largest expense, their mortgage, and it also makes it more attractive to save. So less money in your pocket because you're spending more on your mortgage, and less money in circulation because you're saving it. Therefore, downward pressure. And that is why what inflation is doing is so crucial to interest rates. They say it was a difficult decision to make, but the fact that energy prices are going up so much already because of the price of a barrel of crude oil, that they think that's actually going to increase a lot of people's bills and pull some money out of circulation, therefore having a potentially downward pressure on inflation, but that's yet to be seen. Essentially, the longer the war goes on, the worse it could be. The various sources online then go to say that the longer the war goes on, the more likely we are to have a sustained impact here, and that most people do believe we will have rate increases later in the year. The next meeting will be the 18th of June. What does this mean for you? As I just explained, basically mortgage rates going up means less cash in your pocket, but in terms of the property market and for property investors, it means affordability is lower, certainly more so for people buying homes as opposed to investors. What does this mean? It means that when you've got low interest rates, people are buying, they can afford more because their monthly payments are lower. Therefore, there is a lot more movement in the market, which pushes up prices. When people are unsure or lack confidence or interest rates are rising, it means that your monthly interest payments are more expensive, so people buy cheaper properties or they don't buy at all, and confidence obviously at the moment is hit as a result of that, which again means people aren't buying. Does this mean that the UK property market is going to crash or has crashed? Maybe a trick question. And that will lead on to the third point, why I think there are some reasons to be cheerful despite what you're reading in the news at the moment. So house prices, according to the data, 18-year property cycle, a lot of people online, house prices should crash this year. They're due a crash or due a correction. But if you look in more detail at the figures, because we have had rather large periods of sustained inflation over the past 4 or 5 years, what real house prices have done in relation to inflation is fall. And actually, if you call a crash a double-digit sustained drop, then house prices have already crashed. And by my calculations, it's by about 17.5% to 18% since their peak in 2022. I've got a chart here, which I'll chuck up on the screen, which shows inflation-adjusted house prices. And what's a simple way to understand that? If house prices are flat and the average property is valued at, say, 300,000, but inflation is going up 10% a year for 3 years, the value of your money is 30% less, but your asset has stayed the same. Therefore, the real value of that property, inflation adjusted, has fallen 30%, simple terms. So if you look at the chart, you can see that the real house prices at the end of 2021 that is, were £333,000. Now, fast forward to the end of 2025 and real house prices are at 273,000, which leads on to, I think, the third point, which is why I think there are reasons to be positive despite all the negativity in the market. And yes, conditions aren't great for buying property, they have been better. But if you look at the position we're in, we've got, in my opinion, about 4 years of pent-up demand because the housing market has never really built up enough head of steam to start rolling again, because we had inflation in 2022 and interest rates going up. We were coming out the back of COVID, where we had a weird fragmented market where traditional city centres did poorly and these coastal areas or work from home areas did well, a trend which has reversed. And then we had interest rates and inflation, which meant people weren't making buying decisions even though they wanted to. We've then had a heap of uncertainty around budgets over the past few years as well, which again has meant people have been sitting on making decisions. And if you look at the data from the start of this year, January, February, they're actually some of the biggest months in terms of house price growth. I think January was a record in terms of 0.9% or 1% in that month alone. And that was because the budget was out the way, interest rates were coming down, and this growth, this demand, this pent-up demand was starting to come back into the market. And it was all looking very positive. And then all of a sudden you've got Trump doing what he does in global markets, causing chaos, which has meant that all of this uncertainty has come straight back into the market. And I've seen April called online awful April because of all these events that have happened. So actually I think we're in a position where people are wanting to move, they're wanting to make buying decisions, they're wanting to invest in property, but because of the uncertainty, the extended uncertainty that we've had, they haven't. And so they're sitting on the sidelines and waiting for the right time to buy, or what they perceive to be the right time to buy. And this is supported by a number of stats. You know, you've got real wage growth in the UK, you've got house price to earnings ratio falling, which means it's becoming cheaper to buy a house. You've got rents rising, I think it was 32% in 5 years, which means that it becomes more cost efficient then for people to buy houses. And you had interest rates falling, which means more people could buy more and bigger houses. So all of these things were pointing towards positivity, and we started seeing it at the start of the year. But because of what's happened, confidence in the market has been lost again. So when you factor in to that the fact that we have had a real house price crash in the UK, where does that leave us? Well, we're not actually waiting for a crash to happen because it's happened. We're actually just waiting for a bit of confidence to come back and conditions to come back for all this pent-up demand to start buying again, which will potentially lead to good quality, sustained growth in the UK property market. And again, if you believe in the 18 years property cycle, I don't, but it is interesting data to look at. You have 2 consecutive periods of 7-year growth. So are we coming into that phase? Yes, potentially we are. And if you were like me earlier this morning, reading the papers and getting in a negative headspace about it, don't be. I think obviously extreme positivity or extreme negativity sells headlines, probably more negativity. But if you look at the underlying stats and figures, I don't think we're going to have a crash coming on the horizon because it's happened. The conditions in terms of what is going on within the economy are positive and would suggest more people are buying houses. The data from the start of the year showed that that was the case, but we're sitting in this weird position. Now we've got this loss of confidence with potentially interest rates coming back up again throughout this year, so people aren't making decisions. Should it change your plan and what you're doing? No, buy and hold for the long term and make sure you're buying strategically where the numbers and figures work, even based on higher interest rates.